This is the Dough Roller Money Podcast, episode number 181. My name is Rob Berger. I'm the founder of DoughRoller.net and the host of this podcast. And today we're going to sharpen our pencils and try to calculate the value of a tax-deferred 401k.
Welcome to the Dough Roller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody. Hope you're having a great day wherever you are and whatever you are doing. Today's podcast was inspired by, frankly, from email from you, but a couple of different things. The first one, I got an email, and a listener pointed me in the direction of a video that was published on Business Insider by James Altucher. I don't know if you know who he is. If you're sort of in the online media kind of space or small business startup kind of space, you may know him. He's a very well-known person in those circles, and has a very popular podcast. And I'm not quite sure why he decided to dive into 401ks, because that's not, at least from the shows I've listened to, he's not really a personal finance investing guy. But in any event, that's what he did. And he published a video in Business Insider. If I can get it, I will include it in the show notes to this episode, which you'll be able to find at doughroller.net/podcast 181. But he basically attacked the 401k and listed a bunch of reasons why 401ks are a bad deal. And then he actually did a podcast show on his podcast, where I think he kind of went into a little more detail. And, it was one of those things I kind of enjoy debating these sorts of things. I didn't agree with his views. I thought a lot of what he was saying was accurate factually, but the conclusions that were being drawn, I don't agree with. And that's actually, I'm going to pick one of them, and in some ways, I think maybe one of the more important ones to talk about today. And here was his argument. He said, when you invest in a 401k and then withdraw the money in retirement, you have to pay ordinary income tax on the money you take out. In contrast, if you were to, not put the money in a 401k, pay your taxes on it right up front, and then invest it in a taxable account, you would pay capital gains tax, which is a lower rate. Again, I'm assuming, of course, you hold it for more than 12 months, long-term gains and qualified dividends and all of that, you would pay a lower tax rate. The capital gains tax rate is typically lower than the ordinary income tax rate. And so for that reason, it wasn't his only reason. He gave a bunch of reasons, but this was one of them. Because of that, it was one that he said, just another reason why 401ks are a bad deal. And immediately I knew that while I agreed factually with him, yes, you pay ordinary income tax rates when you withdraw from a 401k, long-term capital gains for long-term investments from a taxable account. I agreed factually with what he was saying. I did not agree with the conclusion he was drawing. And I knew before even calculating, and the reason is simple. Yes, it is a disadvantage to pay higher taxes, and that's going to cost you, but that disadvantage is more than offset by the advantage you get with a 401k, and that is deferring the time when you actually have to pay the tax on the money. And but I thought, well, maybe I should sharpen my pencil and try to figure out some way to actually put a number on this. And that's what we're going to do today. And it came up in another context as well. I got an email. Let me see if I can find it now. Here we go. Got an email from a listener named Charlie. And Charlie's in his 20s, married, starting to take charge of his family's finances, and been listening to the podcast and thinking about his 401k. And he said he'd listened to one show that got him to really open up his 401k statements and start taking a real hard look at them. And he said, I'm discouraged by what I found with American United Life Insurance Company, and I've never heard of them, but I guess they manage his 401k. 1.8% annual asset charge for less than $250,000 in assets, 0.99% investment option charges. He said, based on what I've learned from you, I'm getting beat up by these fees. I'd say beat up, robbed, run over. I think they ran you over. They put the car in reverse and ran over you again. Okay, he didn't actually say that in the email. Let me read that again. Based on what I've learned from you, I'm getting beat up by these fees and need to lower these quickly. I don't see how I could ditch the 1.8% fee, and there are not many options for investments with the plan. There's only 2 available investment options that charge less than 30 basis points. Should I pull what I'm putting into this 401k into less expensive post-tax options? I would, of course, continue with the 401k contributions to receive the employer match of 3%. So I gather from his email, the 1.8% annual asset charge is unavoidable. The 0.99% investment option charge, I think, only applies to certain investments within the 401k, not all of them. So he could potentially avoid the 0.99% fee, but not the 1.8% fee. So the first thing, before we get into the numbers here, first thing I would do in Charlie's case, if I felt comfortable and if I felt I could, I'd go right to HR and see if they, we can work on getting this changed, because that is outrageous. I mean, that is beyond. That's not, to say that's high is just not right. No, it is an outrage. That's what that is. So absolutely, I would work to get that changed. Now, until it got changed, or if it never got changed, my approach and this would be true for any 401k with high fees. If it had an employer match, I would contribute to the match to get the 3%, in his case 3%. Then, if I qualified for a deductible IRA, I would max out the deductible IRA, and then I'd have to make a decision. Do I go back and invest in the 401k to top it off to the amount permitted, in any particular year? It's $18,000 now, or would I just go to a taxable account? In his case, I would go to a taxable account. That'd be what I would do if I thought I was going to stay at this company long term and didn't think they were going to change the plan. If I thought I was going to leave in a year, I might want to take advantage of what I can put away in a 401k. Because this year it's $18,000, but if you don't max out, you can't make up the difference next year. It starts all over next year. You get a fresh $18,000 limit or more if they raise it. But once you don't contribute the max in a given year, you can never go back and make that up. So if I thought I were leaving the company in a year, I thought they were going to change it, I had a good idea, maybe they announced that next year it's going to be a different plan, I'd probably go ahead and make the contribution in the 401k, suffer with the 1.8% for the next 6 months or whatever, but then know that good times were coming. But barring that, if I were long-term and I didn't think this was going to change, I would not be, I would be choosing a taxable account at that point. I think given 1.8%, it's easy decision, in my opinion. That's what I would do. If it gets lower, if it's 50 basis points, where do you draw the line? Right? At what point do the fees become, just make the 401k not worth it beyond the company match? That's what I'm going to try to answer today. That's the very question I'm going to try to answer today. But I will tell you that this answer, I call it a guideline, because there are too many variables and they're going to differ for you, for me, for everybody. Some of them require us to predict the future tax rates, which is, virtually impossible to do, I guess. You just have to make your best judgment. So there is no, single bright line answer. If it's more than 75 basis points, don't invest in the 401k. It doesn't work that way. But hopefully, I can give you enough information so that you can make the assessment for yourself. And, that's my goal. So that's what we're going to do. So I thought we'd start with, just conceptually, to make sure we all understand why tax deferral has value, right? So let's imagine this crazy scenario where I gave you, each person listening, I just each gave you $2,500. And I said, here's the deal. You can invest it. You can't spend it, but you can invest it for 40 years. And then at the end of 40 years, I want my $2,500 back. I'm not going to charge you any interest-free, but I do want my $2,500 back. And then whatever you've earned from your investments, dividends, interest, capital gains, everything, I want 25% of that. But you can keep 75% of any of the earnings. I only want 25%. So I want my $2,500 back, 25% of the earnings. You can keep 75%. And I'll even do this. If for some crazy reason, after 40 years, you end up with less than $2,500, And God help us if that's the case, but that would be a pretty bad run. But if that, crazy as it might sound, if that happens, I won't make you make up the difference. You'll just give me back whatever you have. Let's say you have $2,000. You lost $500 in 40 years of investing. You don't have to pay me that $500. You just pay me whatever you've got, the $2,000 in this case, and we'll call it even. Well, I mean, it's a no-lose proposition, right? I mean, there's no way you can lose from that deal. And that's effectively what the IRS does whenever it allows you to defer paying taxes. By the way, it's not only true with a 401k or an IRA, but any investment that allows you to defer payment of taxes. For example, in my brokerage account, I have a lot of unrealized gains from individual stocks, from mutual funds. I'm sure you do too. And as long as I don't sell, if I have my Berkshire Hathaway stock, I don't sell, and they don't pay a dividend, so I have no taxes to pay on that from year. I can hold that stock forever, as long as I don't sell, and assuming they don't pay a dividend, they will at some point. But I don't pay taxes, so it's not just a 401k and an IRA issue, but that's kind of what we're focused on today. So if you think about it in the context of a 401k, let's just assume, and I'm going to assume a 25% ordinary income tax bracket. Obviously, yours is going to be different. You got to factor in state income tax, right? But for our math, we'll just assume 25% makes it easy. And let's say we contribute $10,000 in a 401k one year. Well, I save $2,500 in taxes that I don't have to pay. That's in effect the IRS saying, hey, that's my money. We get that $2,500, but you can hold on to it. And you can invest it until you withdraw it in retirement. And then when you withdraw it, we're going to assume that the tax rate is still 25%. And yes, I know that's a huge assumption. But if that's the assumption we're going to use, and I don't know what else to assume. I don't know what the tax rates are going to be 4 decades from now. I don't know what they're going to be next year. Then we'll also want 25% of your earnings, but you get to keep the other 75%. That's exactly what happens with a 401k, where you get to deduct your contribution. So, all right, that's sort of conceptually what's going on. Let's kind of look at a still a very simple example, but a little more complex, and we can start to understand, put some numbers to this. So let's imagine you've got $10,000 that you can put in your 401k, or you can pay taxes on it, again, 25%, and then take the remaining $7,500 and put it in a taxable account. And let's just imagine 2 accounts. So you got a 401k with $10,000 in it, and a taxable account with $7,500, and you invest it for whatever, 5 years, and it doubles. Both accounts double. They're invested in the exact same thing, so that at the end of this period of time, let's call it 5 years, your 401k has $20,000, and your taxable account has doubled to $15,000. So $20,000 for the 401k, $15,000 for the taxable account. And by the way, I will have these numbers in the show notes. So if the numbers start to, if it's hard to keep all these numbers in your head, I can cheat here because I'm looking at a spreadsheet, but they will be in the show notes. And so you then decide to just withdraw everything. Again, that's probably not realistic in the context of retirement. You're not going to withdraw your entire 401k and IRA in 1 year, at least in most cases. But we'll just assume you withdraw everything. So what happens with your 401k? Well, we're assuming a 25% tax bracket, so it's easy. You've taken out $20,000, you pay 25% or $5,000 to the IRS, and you're left with $15,000. Now, right there, we know the 401k wins out, right? Because in the taxable account, it's doubled to $15,000. But we haven't paid taxes yet. Now, the way the taxable account would work is we don't have to pay taxes on the investment because we already paid taxes on that money, right? That was after-tax dollars that we invested. But we do have to pay, we're just going to assume all capital gains on the $7,500 that we earned in that investment. Now, just for the sake of discussion, I want to assume at the moment that the tax rate for capital gains is also 25%. Of course, it's not, and we'll get to reality in just a second. But if we were going to assume that the tax rate were 25%, and I'm going to actually pull over my laptop here in front of me and make sure I've got these calculations right, but we're going to take 7,500, right? If you multiply it by 25%, you'd have to pay $1,875 in taxes, right? And so you have $15,000, and you're going to subtract $1,875, and I just want to make sure I got my numbers right. I do. You'd end up with $13,125, less than you have on an after-tax basis from your 401k. So the difference, $1,875. What is that? I mean, how do we think about that $1,875? Well, remember in the 401k example, assuming 25% tax rate, when we invested $10,000, we basically deferred paying the $2,500 in taxes, right? And remember, we're assuming 25% tax rate throughout. So that $2,500 that we didn't have to pay Uncle Sam when we made the contribution, we know it doubled, right? Because everything doubled in this hypothetical. So that $2,500 went to $5,000, and we know that we've got to pay Uncle Sam 25% of that gain, and we got to keep 75%. Hope you're following along. If you're driving, keep both hands on the wheel. Okay, 2,500 times 0.7, right, 75, which is the amount we get to keep, comes out to the difference, 1,875. So yeah, I know there's a lot of numbers going on here. Again, I'll have them in the show notes, but at the end of the day, in this somewhat simplified example, the benefit we're getting is the 75% on the earnings from the money we didn't have to pay Uncle Sam when we made the contribution. Now, of course, I'm assuming 25% capital gains tax rate, and that's not right. So we can imagine that once we factor in the lower tax rate we would get on our taxable account, that $1,875 difference is going to go down, right? The difference isn't that great, and that's, of course, correct. It goes down. If you do the math, you're dealing with, if we assume a 15% capital gains rate, another 10% you're going to lose. And when you do the math, the difference comes out to $1,125. In other words, on an after-tax basis, the 401k nets you $15,000. We know that. The taxable account, if we use a 15% tax rate rather than 25%, nets you $13,875. So the difference is $1,125 in favor, though, of the 401k. So even with the lower tax rate on capital gains, we're still getting a pretty sizable benefit from investing in a 401k. Now, let's go to the next step with this and look at a much more, I guess, realistic and I guess complicated. It's not that complicated, but thinking about investing over a lifetime rather than just a one-time investment that doubles in a few years. So I assumed a $10,000 investment in a 401k for 40 years, earning 8%. What would that get you? Anyone? Okay. Just under $2.6 million. It's not bad. Of course, it's 40 years from now. It won't be worth that much. And then for the taxable account, I assumed the exact same thing, except that we have to pay taxes on the $10,000. So we're only going to invest $7,500 a year. And so that brings our result down from $2.6 million in the 401k to about $1.94 million in the taxable account. Now, we've got to factor in taxes. And so for the 401k, again, I'm just going to assume we pull this all out at one time. Again, not a realistic assumption, but it just makes the math a heck of a lot easier. So you're going to pay ordinary income tax on the roughly $2.59 million. You're going to pay 25%. It nets you $1.94 million, which, by the way, is the same taxable number that you end up with before taxes, and that makes sense. When you pay taxes on your taxable account, of course, you don't have to pay taxes on your contributions because those were after tax. That was $300,000. So after we factor that out, apply a 15% capital gains tax, you end up with about $1.7 million. So $1.7 million roughly versus roughly $1.94 million. You're talking $240,000 after tax difference. It's huge, absolutely huge. So there's no question, again, with the assumptions I'm making, we're going to talk about those assumptions in a minute because they're really important. There's no question, the 401k clobbers a taxable account, even with the lower tax rate on capital gains, clobbers it. Now, then I started to think, all right, well, let's kind of factor in Charlie's email and fees that you pay. Now, I didn't use his 1.8%. What I tried to figure out is how much in fees, if I started to pay extra fees in a 401k, at what point would it bring down my after-tax number to something equivalent to the taxable account, right? So I just basically used the same calculations in a spreadsheet, except rather than assuming an 8% return for the 401k, I started assuming lower returns, the difference being, some hypothetical fee. My first number, I thought, well, I'm assuming 8% for the taxable account. Why don't I just assume a 1% fee in the 401k? And so that would bring my return down to 7%. And what would the after-tax number look like? Well, I was actually surprised at this. So remember, our taxable account after taxes has roughly $1.7 million. If we just lower the return on our 401k by 1%, it drops to 1.5, actually 1.497. It's a $200,000 difference between the taxable account and a nearly $450,000 difference between the 401k example using 8%. In other words, even a 1% fee, let alone Charlie's 1.8% fee, it's going to wipe out the difference, the benefit you get from the 401k, and then some. It's going to make you worse off. So when I did the numbers and I started assuming different returns, what it came out to was basically 7.5%. If I assume 7.5% on the 401k and 8% on the taxable account, they both come out to roughly $1.7 million. Just a 0.5%, 50 basis points. Now, I said it earlier in the show, there's no bright line test. This don't take from this the notion, so if my 401k investments, either through some sort of administrative fee or just the expense ratios in the funds are higher by 50 basis points or more, I should forget my 401k, at least forget it after I've maxed out enough to get my employer match. We can't draw that conclusion. And I'm going to walk through some reasons why. But you certainly, I would say this, when you get to that kind of number, it certainly should be a red flag that you should be evaluating. And really we should be evaluating any fees. But if you get administrative fees at 50 basis points or more, obviously the lower the better. But if you get to 50 basis points or more, it should be a red flag and you should be looking at it. But why do I say it's not a bright line test? Well, there's a number of reasons. First of all, as I kind of alluded to earlier, you may have an expensive 401k, but you don't think you'll be there long. And you want to go ahead and put your money in the 401k because if anything you don't put in a given year, you can't make up. So you may stomach the high fees for a year or two, knowing that you're changing jobs and can either roll the 401k into your new employer's 401k or just roll it over to an IRA. That might be one reason you might, stomach high fees. So that's one. Second, this is so important. I've assumed the same tax rate at the time of a contribution as you'll have when you take the money out. Now, there's a lot of uncertainty there, but there are some things that you may know that can help you figure that out. The key is this. The higher your tax rate is when you make the contribution and the lower it is when you take your withdrawal, the more valuable a 401k will be. So for example, if I had assumed you're paying 39.6% tax rate when you make the contribution, but you'll only be paying 10% when you take the withdrawal, the value of the 401k would have just gone up significantly. And the reverse is true. If I'd assumed 10% when you made the contributions as your tax rate and 39.6% when you take the withdrawals out in retirement because you just had a great career and you became very, very wealthy and whatever, then the value of the 401k would have plummeted. And that's one reason, by the way, that it's my view that if you're in the lower tax bracket, let's say lower two tax brackets in your working years or some of your working years, it's generally better to use a Roth 401k, Roth IRA. And likewise, if you're in the higher brackets, it's generally better. There's always exceptions, but it's generally better to be in a traditional pre-tax retirement account. And if you're in the middle, it's a toss-up. There's you got to look at other factors and kind of think about where your career is going and what you think you'll be like in your financial situation will be like in retirement. And there's no easy answer. But the thing I want to stress is the numbers I walk through assume the same tax rate when you make the contributions as when you take the withdrawals. That is a huge assumption. And that just may not be realistic for you. The other thing to keep in mind is that you may be in a high tax state right now and planning to retire to Texas or Tennessee or Florida, some other state that doesn't have an income tax in retirement and might give you a good reason to believe your tax rate will go down. Or maybe the opposite is true. I don't know, maybe you're in the oil industry and you're in Texas, probably suffering a little bit right now. I hope not, but you're in Texas, but you just want to open up a vineyard in California when you retire, and so you're going to move to a high tax state. I don't know. But it's something to think about. So that's another kind of assumption that's significant. Another one is I've assumed on the taxable account that all of your taxes will be paid when you take the withdrawal. That's by and large for most investments not true. Certainly if you own a stock that doesn't pay a dividend like Berkshire, it's true. But if you have stocks that pay dividends, you're going to get dividends each year and pay taxes on them. If you own any sort of bonds or have money in a savings account, you're going to get interest and pay taxes on it. And for mutual funds, not only could you have dividends and interest, but you could even have capital gains distributed to you, even if you don't sell any shares of the mutual fund. And these taxes that you pay, even if you imagine, say, a yield of 2%, dividend yield of 2% or whatever, doesn't seem like much from year to year, and I guess maybe it's not, but it adds up. And it can easily, I peg it at 30 basis points, can lower your return. But again, that's a huge assumption that depends on, that's what I look at for my investments. But that's going to vary based on your tax bracket, where you live, your state income tax, the amount of yield on your investments, and all kinds of factors. But that's something that doesn't get factored into my numbers. It's really kind of impossible almost, really. It just varies on so many variables. But you ought not discount the taxes you're paying each year on income that you receive from your taxable accounts. They do. I mean, again, the more you can defer paying taxes, the better. And so paying those taxes each year, it does lower your overall return. So even with the 50 basis point number I calculated, assuming all of the things that we assumed, that might really be 70 or 80 or 90 basis point difference, really, when you factor in the yearly taxes that you could pay each year. The other thing I would say is that sometimes the fees come not in the form of some sort of administrative charge, like the 1.8% that Charlie's suffering with, but with just higher fee mutual funds. Well, you got to really kind of do second level thinking, as I call it. I have a fund, for example, that I pay 64 basis points for in my 401k. And if I were going to get a Vanguard fund, which is not an option in my 401k, I could easily save 50 basis points. So one way to look at that is, that's the 50 basis point mark that we talked about. Red flag, let's look at it. That's fine, except that the fund I'm talking about is Dodge and Cox International Fund. It's a phenomenal actively managed fund. And I don't know, there's no guarantee that it will beat the market or whatever, but I am reasonably confident that it will make up for a good part, if not all of, its 64 basis points fee. And in fact, when I look at history over a very long period of time, that's what it's done. So if you've got, to me, actively managed funds that charge 60 to 70 basis points, that's actually a low-cost actively managed fund. To me, that's a fund that's likely very concerned about costs. Keep in mind, Vanguard has actively managed funds. Vanguard is not an index fund company. It is a low-cost fund company, and it has actively managed funds. So if you have actively managed funds in your 401k and they're charging 50, 60, 70 basis points, don't just assume that your after fee return as compared to, say, index fund investing is going to be 50, 60, 70 basis points lower. You really need to look at the fund, look at its history, and keep an eye on it. Again, what I've tried to do here is explain from my perspective conceptually why tax deferral in the context of 401k has value. Try as best I could to put a number on it, but then give you all the reasons why in your situation, and even in my situation, that specific number may be inaccurate. It may be wildly inaccurate depending on your tax situation. So it's really important for you to kind of think through those issues. I wish I could give you a bright line test or say, hey, here's a calculator. Just go put in a couple of numbers and out pops the answer. If life were only that easy, it'd probably be boring. Wouldn't it be boring if life were that easy? And regardless, it ain't. So there you go. That's my take on it. Would love to hear your thoughts and comments. So let me run through all the info on the show. So if you want to respond to this and have comments, questions, topics, you know where to reach me, dr@doorroller.net. You can leave me a voicemail. Just go to doorroller.net/voicemail. And you can leave a voicemail from your phone, your tablet, anything with a microphone, your laptop. And I do have a couple more that I need to get to, by the way, on voicemails, and I will be. I get to those quicker, I've promised you, than some of the email. So if you want to leave me a voicemail, that's where you do it. If you want to see the show notes with all these numbers, just go to doorroller.net/podcast181, and that'll redirect you to the show notes. By the way, if you haven't subscribed to the newsletter, you can do that at doorroller.net/newsletter. And I send out just one a week on Saturdays, and it includes links to the shows, to the content from the past week. And that would be another way to make sure you don't miss any podcasts and the show notes. Of course, you could always subscribe in iTunes as well. And lastly, before I let you go, I have decided to make this an advertisement-free podcast. So it lives based on your support. So if you'd like to support the show with a small monthly contribution, you can do that at doughroller.net/support. Well, there you go. There's my number crunching for today. Again, would love to hear what you think. And hey, hope you have a great day. Until next time, remember, the best thing money can buy is financial freedom.